Welcome to this video tutorial on the Berry ratio. We're going to begin by talking about the definition of the Berry ratio, how it's calculated, and what can affect it. In this slide you can see the definition of the Berry ratio. It's equal to essentially the gross profit divided by the operating expenses. And mathematically in this formula we think of the gross profit as the revenues, which is the price times the quantity of goods you sold, less the COGS, and that divided by OE for the operating expenses. Now, when you use this transfer pricing profit level indicator, where is the transfer price going to be affecting this equation? Well, generally, it's going to be in the COGS. A Berry ratio is normally used for a distributor, and it's used in some very special cases of distributors, those in which the variation in the ratio of operating expense to COGS is affecting how you're perceiving the profitability relative to the services rendered most commonly. So if this is how you're measuring your profit level indicator, what are things that could undermine this profit level indicator as a tool to determine if pricing meets the arm's length standard? One of the first issues that comes into play when looking at the Berry ratio is to ask the question of whether the costs separation into COGS and operating expenses might be different from that of the comparables. If there's a difference in that decision as to how a certain expense ought to be allocated to one or the other, it'll be moving an item from the numerator to the denominator, and you'll get variation in the Berry ratio, not that as a result from normal variation in arm's length pricing, but from a difference in accounting standards that two different firms might be employing. This kind of problem can usually be addressed by carefully looking at the 10Ks into the notes of the financial statements and determining how various specific costs are being handled, and adjustments can normally be made. One of the other issues that can affect the Berry ratio is if the transfer price, that portion of COGS that's from a related party, is only a small portion of total costs. In this case, you'd be looking at a transaction in which the fluctuations in the related party price might be swamped by transactions with unrelated parties, so there are other sources of other suppliers or other sources of your COGS. This first item that we've mentioned up here would actually distort the measure and could cause you to draw a wrong conclusion. The second item is more likely to just make it insensitive, and you may need to look at a different approach to the transfer pricing that would improve the sensitivity of the profit level indicator to changes in the transfer price. Thank you.
Welcome to this video tutorial. The title of this tutorial, The Berry Ratio, When is it appropriate to use? In a previous tutorial, we already discussed the definition of the Berry ratio and what can make it insensitive to transfer pricing analysis or to distort its results and maybe draw false conclusions. In this tutorial, we'll be looking at the Berry ratio and when is it appropriate to use it. Well, when should you use the Berry ratio? In essence, the Berry ratio is commonly used for distribution companies where there is an operating expense to total cost ratio that is either 1, different between the tested parties and the comparables, or 2, highly variable over time. Well, let's go back to that first point. If it's different between the tested parties and the comparables, we want to think about two different possible scenarios that might be causing that. The first is that the tested party might be providing a different level of service relative to the comparables that is being captured in the operating expenses. Say this whole sales process might be a very intensive effort where you're educating the consumer about the product, in which case your operating expenses might be much higher relative to your COGS than might occur for another provider. The other possibility is a case where the tested party and the comparables provide a very similar level of service, but the product being sold, what's showing up in the COGS of our analysis, is very different. We're going to go through a couple of examples in other videos of each of those cases and develop them a bit more fully. The third case that can come up when the Berry ratio may be appropriate is when the operating expenses to COGS is highly variable over time. Now, this might happen most commonly when you're dealing with a distributor of a commodity that experiences high price volatility. Say, for example, you're distributing oil, crude oil, let's say. It may be that when the price of oil goes up and down, you'd want a situation where the distributor is being rewarded for the services being rendered. In cases like this, often the distributor is actually rewarded with a price per barrel sold as opposed to some number that's contingent upon the value of the number of barrels sold, because that will be going up and down with the price fluctuations in the market for the price of oil. If we've been looking at a different profit level indicator, that base of being sales might be going up and down rather substantially, which could cause the PLI to fluctuate up and down if we've been looking at, say, an operating margin or a net cost plus. Thank you.